So what do federal funds rate cuts mean for you? My name's Chris with Equity Real Estate. I help buyers and sellers in Oregon, Southwest Washington navigate the buying process and selling process. But when it comes to Fed funds cuts or increases in the rate, it's commonly misunderstood how that impacts buyers and sellers. So when it comes to the federal funds rate and they lower rates, that has a more direct impact on things like credit card interest rates, auto loans, HELOC, which is a home equity line of credit, and then also directly controls the federal funds rate for like bank to bank lending. Okay, because banks are required to, as a financial institution, have a certain amount of cash on hand. So sometimes banks have to borrow money from each other in a short term, so that way they have those funds needed and follow those guidelines that they're required to. But it doesn't just mean that if the Fed funds rate gets cut by 25 basis points, that all of a sudden interest rates come down with it. That's not quite how it works. So it's more impacted by interest rates are tied to more the bond market and what's happening with like the 10-year treasury note and the bonds, things like that. Then it has to do with inflation as well. So if inflation is kind of getting out of hand and people are spending, 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 then they will increase rates to kind of put a damper on things and kind of control it so you don't have, you know, spending going rampant. And then also economic uncertainty overall, and then investor demand. So think about kind of why rates got so low during COVID, and it had to do with the kind of economy just got very stagnant and, severely declined for a bit because everyone was so worried about COVID and, businesses are shutting down, restaurants, services, gyms, whatever it might be, things were kind of locked up and people weren't going out and spending money like usual. So it just kind of locked up the economy and obviously had a lot more to do with than just gyms and restaurants and things like that. But those are kind of like the day-to-day things that are easy to think about. So when you have this lockup happen, all of a sudden people aren't spending money, then to increase that spending and to get people to start spending more and kind of doing more, they lower interest rates. And that's where we really saw people do a lot of like outdoor patios here in the Pacific Northwest. Kind of like that outdoor living area was, built and added on to a lot of homes locally because people had to stay home, but they wanted to enjoy their house. So they kind of did that to have a little bit of an escape and get away from that cabin fever, so to speak. Or they just said, hey, we're just going to buy a new house altogether. And then they would, sell their house, buy a new house. That's when we saw, extremely low rates, extremely high like appreciation rates or just, the bidding wars, people trying to outbid each other, things like that. Um, so that's what led to that. And so then as we kind of escaped the COVID years, then all of a sudden rates had to adjust for that. And they, in my opinion, they kind of waited along, right? Rates were low for quite a while before they started to kind of increase them and they said, oh, hey, this is getting out of hand. And I think a lot of people kind of boots on the ground could have said, hey, this is getting out of hand, 6 months, a year, or more maybe before they started to raise rates. But they've got their numbers and they go over their data the way they like to. So I'm not the decision maker there. So that's kind of what led to the COVID rates to begin with. And now we're kind of out of that. But with other economic uncertainty and different things happening with the administration and, Fed rates overall, that's why we're seeing rates kind of where they're at. Going forward, what adjusts rates and how does the federal funds rate impact mortgage rates? You can see sometimes when the Fed talks about, oh, we think we're going to lower rates, the data looks good, or the data backs a reason to lower rates. They're looking at some of the job numbers, inflation, stuff like that, and so that'll lower the Fed rate. And then if they talk about ahead of the Fed meetings, if they talk about lowering the rates and they kind of imply or kind of drop like hint that they're going to, they're expected to drop rates, then the market will price that in. So then when the Fed rate comes, the market will kind of price already that drop in. So then the meeting happens, then they say, "Hey, we're actually gonna drop rates like we said." Then all of a sudden, nothing really happens with mortgage rates because it's already been priced in for a week or 2, and you can kinda see those on the charts. But on the opposite side of that, you'll have where if they talk about a rate cut, they don't do a rate cut, you might see mortgage rates kind of jump up a little bit. And when we say jump, I mean it's just fractions, but when you're talking about percentages on mortgage and loan amounts in the couple $100,000, it makes a difference, right, on your monthly basis. So when you have those, either they don't do what they said they're going to do, or they kind of change their mind, or they don't do a big enough change as far as people kind of expect rates to drop this much, and they only drop, they drop half of that. Let's say instead of 25 basis points, they drop 10 basis points, 15 basis points, whatever. Then the market probably already priced in that 25 basis point change, and so it'll kind of bounce up because it's like, oh hey, we were wrong, or they didn't do what we thought they were going to do, so it'll be adjusted based on that. So if the Fed rate changes both up and down, it might not be a direct change to mortgages, but in the long term, lower Fed funds rate has a, kind of a lagging period with interest rates. And so rates will interest rates for mortgages will tend to fall as the Fed fund rates fall. So overall, it might not be tied to it directly, but it can have an impact on it, and they are kind of tied to each other. So as one falls, the other one goes with it typically. So that is how it impacts buyers. I hope you've learned something. If you have questions about fund rates, anything like that, or how it impacts you, feel free to drop a comment down below, like and subscribe to get more information about the buying process or other market updates and education. Thank you.